Hello viewers. Today in this video we will learn about mutual funds related to the stock markets. So, what are mutual funds? A mutual fund is a financial vehicle that pools assets from shareholders to invest in securities like stocks, bonds, money market instruments, and other assets. Mutual funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Mutual fund type depends on the defined objective and the underlying asset. Following are the different types of mutual funds. Equity mutual funds. Equity mutual funds invest the pooled money majorly in stocks of different companies. Hence, equity mutual funds have an inherent higher market risk. Factors like earnings, revenue forecasts, and economic policy impact price movements and the returns. Returns from equity funds have high fluctuations. Hence, you should invest if you have a fair understanding of the asset class risks associated with equity. Debt mutual funds. A debt mutual fund invests a major portion of the pooled corpus in debt instruments like corporate bonds, debentures, and money market instruments. The bond issuers borrow from investors by giving an assurance of steady and regular interest income. Thus, debt funds are less risky in comparison to equity funds. The debt fund manager ensures that the fund is invested in the highest rated securities. The best credit rating signifies the creditworthiness of the issuer in terms of regular interest payments and principal repayment. Balanced fund. The name comes from the asset allocation as the fund is allocated in both equities and debt instruments in defined proportions. The objective of the balanced fund is to have reasonable growth and regular income with the lowest possible risk. Fund managers of these funds normally allocate around 60% in equities and rest on debt instruments. NAV of balanced funds is less volatile as compared to equity funds. Now, let's see the pros of mutual fund investing. First, we have diversification. Diversification, or the mixing of investments and assets within a portfolio to reduce risk, is one of the advantages of investing in mutual funds. Next, we have easy access. Trading on the major stock exchanges, mutual funds can be bought and sold with relative ease, making them highly liquid investments. Then, we have economies of scale. Mutual funds provide economies of scale by foregoing numerous commission charges needed to create a diversified portfolio. Talking about the cons of mutual fund investing. First, we have factor of no guarantee. Like many other investments without a guaranteed return, there is always the possibility that the value of mutual fund will depreciate. Then, we have cash drag. Mutual funds require a significant amount of their portfolios to be held in cash to satisfy share redemptions each day. And last, but not the least, we have high cost. Mutual funds provide investors with professional management, but fees reduce the fund's overall payout, and they're assessed to mutual fund investors regardless of the performance of the fund. For conclusion, we can say, a mutual fund is a powerful investment option that has the potential to generate long-term wealth for investors. Also, mutual funds have schemes for all types of life goals, right from creating a pool of wealth to retirement. You have schemes for risk-averse and conservative investors. You can contact us from the details mentioned on the screen via a call, WhatsApp, or email. Thank you for listening the video to the end. Please do like, share, and subscribe the video for the latest updates in the market.